Strategy MSTR is a beast of its own. Almost 800,000 Bitcoin on their balance sheet, more than 3.5% of the entire Bitcoin supply. And with that, having almost 20 times more Bitcoin than the second best Bitcoin treasury company. My theory to strategy is very simple. If Bitcoin is the biggest and most dominant asset in the world, isn't it logical that the company with the most Bitcoin will be the most valuable company on planet Earth, or at least one of the most valuable companies on planet Earth? And with strategy being very far away from that, there is a huge return baked into the stock. And so they asked Adrian Morris, one of the OG MSTR True North guys, what he thinks about the treasury company space and MSTR strategy especially. Enjoy.
What's your core thesis on strategy, on Stretch, and all the preferreds that they have?
So when it comes to strategy, the core thesis, if I had to really simplify it, is that they are a company that now has over 760,000 Bitcoin. When I first got into it, they didn't even have 100,000 Bitcoin. And watching the growth over the last 5-6 years has been really impressive. And if I had to distill the thesis down to one talking point, it would be that if Bitcoin is going to succeed, if we are correct as Bitcoiners that Bitcoin is going to succeed and it's going to become the preeminent asset in the world, or one of the preeminent assets of the world, then it stands to reason that the company that holds the most Bitcoin and that can financialize Bitcoin the most effectively would be a huge success as well. And I think that is the simplest way to talk about strategy, and then the actual thesis behind it. They are a company that has been acquiring Bitcoin. They have been financializing Bitcoin. And because of the nature of equities, they tend to trade at a premium to their net asset value of their Bitcoin holdings. And those pieces are what tend to attract investors into strategy. Of course, you have individuals that are chasing, number go up, right? But people like myself, people like the other gentleman in True North, people perhaps like yourself, would perhaps be more inclined to invest in strategy because of the underlying Bitcoin thesis that's driving it.
This is so interesting because I have been so impressed by how many Bitcoin they have been accumulating. I remember not that long ago where we have been discussing on the podcast if they can ever get to 1% of the Bitcoin supply. Not even like when, like we've discussed if they can ever do that. Now they had like 3.5 or so, and I'm fairly confident that they can get to 4%, 5%, maybe even like 10%, like around the 2 million Bitcoin mark. It's still kind of hard to me to think about how many Bitcoin they can actually accumulate and where's kind of the top. I mean, the most natural top is 21 million, I guess, but there's probably a limit before that at some point. But it's really like I'm massively impressed by how many Bitcoin they can just accumulate with so many interesting strategies, and there's no competition. Like it's great. Like the second biggest one has like what 40,000 Bitcoin or 100, like I don't even know, like 50,000 or so. Like not like a lot less Bitcoin than strategy.
Yeah, and so part of that is the first mover advantage, right? They were the first company to adopt a Bitcoin strategy, and they were able to accumulate Bitcoin when it was much lower, right? So during the bear market of 22 and 23, they were still they were there, and people were thinking they were going to get liquidated and all of that, right? We know all the talking points. So a lot of that is the first mover advantage, and because of the first mover advantage, they may have an unassailable position as the number one corporate holder of Bitcoin. I think that unless someone in the Mag 7 were to get involved, no one's going to be able to catch that number. And even if that were to happen, even if someone in the Mag 7 were to get involved, that would cause the price of Bitcoin to completely blow out, and they'll be constantly chasing the bid all the way to the top. So I don't think that's going to happen. And that by itself at some point is going to command a different kind of premium for the market, but that's going to take some time for Bitcoin to be more broadly adopted globally, and for Bitcoin to adopt a more, or for Bitcoin to develop a more durable narrative. Once those events take place, I think that strategy, their position is going to be far more concrete, and it's going to be well well understood by the broader market. But that's still years away. In terms of how they've been able to accumulate, aside from the first mover advantage, they've been relatively focused on the Bitcoin treasury strategy. Just today we saw the marathon sold like what 15,000 Bitcoin, however many Bitcoin it is they sold and even though that they are a miner, it shows that you have companies in the space that are believers and practitioners of the Bitcoin thesis. So what I mean by that is that they believe that Bitcoin is the best asset in the world and they follow through on that, right? While you have others that are whether they are need to sell Bitcoin because of they have different operational constraints and they can't hold on to all their Bitcoin, or that you have others that have entered into the space or perhaps don't have as a developed investment and financial capital thesis behind their Bitcoin holdings. All of these things are what separates strategy from the pack and makes them a one of one. So, yeah, we can talk about things in greater detail. And now you have the preferred offerings as well with Stretch. And Stretch has shown extreme resilience. Stretch has shown that it's been well received by the market. So they've added another layer onto the financialization of Bitcoin that didn't exist before. And I think that they're going to continue to innovate.
What do you think is the one thing that will make strategy and maybe also other Bitcoin treasury companies either successful or unsuccessful? Like, what do they have to achieve over the next like 5-10 years to keep on being successful or to like become successful?
Well, in the case of strategy, even if they were to do nothing from this point on and just ride Bitcoin price accumulation, even if the market were to pin them to one x NAV, one x MNAV, they're going to be a tremendous success. The share price is going to blow out, and they're going to be successful. So I think they are. I'm not going to say guaranteed success. I think that they are relatively well on their way to long-term success, assuming the underlying Bitcoin thesis is correct, right? That is always the caveat. We are Bitcoiners, we are Bitcoin believers, so we are fundamentally assuming that the Bitcoin thesis is correct. And because of that, strategy will become successful, right? So that is the base case for success. In terms of what they can do, I think that with the preferred offerings, they've already taken another step towards a financialization of Bitcoin. Now, here's where I would differ from some others in the space that think that they don't need to do anything else. I would actually disagree with that. I think that the market is adaptive and the market is going to demand more from them as time goes on. I don't know if just buying Bitcoin, holding Bitcoin in perpetuity is going to be enough it indefinitely. I just don't see that as realistic. So I think that the future would be lending on Bitcoin. I think the future could be finding different ways to generate yield on their Bitcoin. I think the future can be different offerings that we perhaps even haven't even conceptualized yet. It could be reappropriating existing offerings, changing their structure, and creating different offerings from them. There's all kinds of different things that they can do that are going to determine their future success. And I think that all those avenues open up for them. I also think that, again, where I'm going to be different, I think that if they're not going to abandon the business intelligence side of the company, they need to develop that as well. And I think that also bodes well for their success in the future. I think that they can truly be a dual model in the sense of they can be a strong analytics company because of the future and the way things are going with AI, but they can also be a strong treasury company as well. I don't think that that is impossible, but they're going to have to make a concerted effort that we have the Bitcoin treasury. We would like to incorporate some of that growth and push some of that growth into the business intelligence side of the house as well. So they have many avenues to become successful to expand their success. In terms of the other treasury companies, so far a lot of them have essentially taken the approach of we see what strategy is done, we're going to copy that right now. Can that work? Perhaps. But I really think that, and this is something I've spoken about at length, the differentiating factor, what is it? If you're just going to copy strategy, well, why wouldn't someone just buy strategy? If you don't have a differentiating factor, so like in the case of Metaplanet, for instance, they're in Japan, right? That's a differentiating factor, a geographic one. That could be true for other companies like Smarter Web, Capital, so on and so forth. But the companies that are going to succeed are going to need to have a differentiating factor. Now, the challenge with that is as strategy gets bigger and bigger and bigger, that differentiator becomes more nebulous and it becomes less certain. So the reality of it is that the future of this space, the Bitcoin treasury space, I think is going to be strategy's growth. I think there's going to be a lot of mergers and acquisition and consolidation to make bigger companies. And I think that companies that can differentiate besides strategy are going to be the ones that can survive.
Yeah, that's also something I always think about with other treasury companies. Like, to be super fair, I focused the last 3 months purely on strategy, on that research, and I will soon post like a full thesis video that like how I think about strategy. And after that, I'll see into the other strategy companies. So I haven't really um, put a lot of effort or time into other treasury companies, just as a preface to my question now. But I always have this question: couldn't strategy just do the thing that they are now doing in America, in Europe, in Asia, in Japan, also with like meta planning? And couldn't they just do that and because they're the big dog, kind of almost destroy their whole business model? I mean, like, it sounds a little bit extreme, but like they could be a huge competition also in the Japan market. Like, what would stop them to just do that?
I'm not 100% certain, but if I had to like hypothesize, I would say that you have regulatory concerns. Are there any kind of regulatory hurdles that they'll have to clear before they can move into foreign markets? You would also have brand recognition. If they were to move into like Japan for something, for instance, why? How would they be received in contrast to Metaplanet? How would they be different? Are they just going to offer like a Japanese market yen denominated version of all their offerings, or are they going to do something different, right? And you already have Metaplanet that exists in the market there right now, but this is kind of what I've spoken about in the past, that I think strategy is moving towards becoming systemically relevant and systemically important. So systemically relevant in the sense of, because of their size, because of their footprint, they are now a relevant player in the market. They are now a recognized player in the market. Or, to your point, they may become the market because they're so big. They are just the market for the financialization of Bitcoin. So that's systemically relevant. Systemically important means that Bitcoin has gone to such a size by itself, and Strategy's holdings have gotten to such a size by themselves that they now have become integrated into the plumbing of the traditional financial system. I think that the relevance is the near-term goal. I think importance is the long-term goal. That is what they're working towards. Now, how does that play into what you're saying? If there's a future where, and let's play it out 5 years, right? Let's say that Bitcoin's at a $500,000 or something like that. They have a monstrous market cap, and that's assuming that they don't trade at a multiple. At that point, if Bitcoin is a $500,000, we have a few tacit assumptions with that. We have, of course, more capital in the market, right? We have, of course, more broader financialization of Bitcoin. We, of course, have more recognition of Bitcoin globally and more adoption of Bitcoin globally. And what that means is strategy is going to become a direct beneficiary of that. Now, if in your scenario, they have, let's say, 1,000,000 Bitcoin by that point, and Bitcoin's at $500,000, and they're moving into why wouldn't they move into other markets? What would prevent them from moving into other markets? And would these other companies be large enough to compete with them in those other markets? That is the real question. And I think that is something that they're probably thinking through, but it's premature at this point. But to answer your question and more completely and directly, nothing is stopping them from doing it. Besides regulatory hurdles and whatnot, if we assume that those will not be a long-term barrier, nothing is stopping them from doing it. The real question is, would they be able to handle the expansion into other markets? I think they have to be very, very careful in what and how they're building out, because there could theoretically become a crisis of scale if they keep scaling on the preferreds and if they keep putting a consistent dividend bearing pressure and dividend perhaps pressure is the wrong word. A dividend, just say simply a dividend obligation. If they keep expanding their dividend obligation without being able to offset that in other means outside of the common stock and the common business supporting it, I think that that can get a little bit dangerous if they expand too far too quickly. So all of these things are things that they're probably working through. But if we assume the scale, if we assume the desire, nothing's stopping them. And I think that that's something that's probably going to happen in the future.
So there is a concern of yours that they might that if they do those things that they might grow too quickly. So like in order to do such a massive scale, they should do it carefully, conservatively, and slowly, instead of just like going randomly in all the markets and like expanding their branches. I mean, it's I don't know if branches is the right word, or but like different jurisdictions too fast.
Think of it as their footprint, right? So they have been very, very conservative. They're contrary to what people believe, and see the FUD online, people talking about leverage and whatnot from the convertible notes and so and so on, and because of the application and whatnot, that's actually overstated. They're not heavily leveraged. If strategy was irresponsible, they would have taken out far more convertible notes than they did far earlier, but they didn't. So what that means is that they are naturally, just by virtue of how they've been operating, they are being conservative. Now, the point I'm referring to is what I like to think of as a crisis of scale. If you think of Stretch, if you think of the preferred offerings, if they scale that out further, so we have to assume that they're scaling out further because the demand is there. So we have to assume also that Stretch, all the other prefers have the volume here, the volume that exists currently here in the current state to support pushing out in the future state, right? Now, the reason why I call it a crisis of scale is as the preferred offerings scale and as they become more innumerate, the dividend obligation grows in tandem, right? If there's a scenario where you have a growing dividend obligation and the core business, either through the trading volume or whatnot, or the core business can't support that growth, you then are put into a position where they theoretically would have to sell Bitcoin to cover the dividend obligation. Now, that somewhat undercuts the thesis, right? Because I wouldn't think of that as a negative. I would think of that as they're simply adopting to the market and maintaining their capital stack as efficiently as possible. And that may at some point require them to sell Bitcoin, hypothetically. I'm not saying that's going to happen. I'm just giving you the hypothetical. How does the market react to that? Does that undercut the confidence in strategy? Does the market then say, well, now we have to price an additional risk because of these dividend obligations, and then it undercuts the thesis even further? There are all kinds of things to consider. And that's what I mean by they have to be very, very mindful and very, very conservative in how they scale these out into other markets, if they can and if they choose to. But they have shown themselves to be very conservative. They've shown themselves to be very responsible. So while I think that is a tail risk, it is a risk that I do consider when I project forward and I try to model out what can happen with strategy as a company.
Is that why the US dollar cash reserve is kind of a genius move? Because if they always keep it at like 2-3 years of covering the dividend obligations, those risks are kind of not really there, at least not in the short term, because if they always keep like enough cash there to not be relying on the ATMs or not be relying on selling Bitcoins, they can always cover those obligations with the US dollar reserve.
Correct. The US dollar reserve, in my view, was a signal to the market saying If there's concern about dividend coverage, we now have 2 years and change, right? That's a very simple way to look at it. Now, I think, and this is just my guess, that as they scale, the cash position that they have in reserve is going to have to scale as well for the very reasons you just laid out. But again, if you're thinking about a global rollout, they will need to have a very, very large cash position. Can they do that? Absolutely. And I think that they're probably going to do it. But again, I'm just calling out the tail risk here. Am I saying that it is a risk in the sense of that it's probable? No. I'm just saying the possibility is I have to consider it. And that's just something I like to call out. But they are reducing it significantly by being as conservative as they are and having the cash reserve. But I would assume and expect to see that as the dividend obligation and the adoption of these preferred offerings grows, so does their cash position. If the cash position were to stay where it is right now and the coverage and obligation were to scale proportionally, then I'll be, somewhat surprised. I wouldn't be concerned, but I would still be surprised that they haven't grown the cash position in proportion. But I think that they're going to scale it out. I do. I think they're going to scale it out. They're going to scale out the cash reserve, and they're going to scale out the offerings. However, I can't just be blindly bullish. And I do have to say that there is a crisis of scale that is theoretically possible. And it's just something that I like to call out.
I like that because I think the worst thing that someone could do, just like researching something, getting bullish on it, and closing their eyes towards risks. That is the worst thing you can possibly do, because you might be right at one point, but things can change within like 1 year, 2 years, even things can change over months. So I think that's also something very important to call out, that strategy is something very different to Bitcoin. Bitcoin, you might not have to do as much research on the ongoing basis. Like once you research Bitcoin and understood it, you don't have to keep on researching it all the time just to reiterate what Bitcoin is doing, because there's no management team, there's no crisis of scale. You might benefit from actually looking into it and still seeing, are we in the right direction? But with a company, there's a lot more things that can go wrong. I mean, with strategy, there's all the things that can go wrong with Bitcoin, plus a management team, the stock market, on all the things on top of Bitcoin, I guess.
There is without making anything that can seem like a political statement, we've seen how a single social media post from the United States president sends the markets into a tailspin or into a frenzy. Right now, I anticipate that is something that is going to become more and more prevalent as time goes on, just because of the nature of markets and just because of how sentiment, I believe, moves markets, and algorithms are going to become more prevalent, and AI is going to make trading even more high frequency, in the sense of you're going to see shifts in the market that are far more volatile and violent because of the sentiment driven reactions of algorithms, right? So with that said, just project that forward. 5 years ago, I would have never thought that a president can make a post that's going to cause the market to tank or going to cause the market to rip. I wouldn't have thought that was possible, but here we are, right? So that alone is an unknown that we can't really project into the future. That can create a lot of shifting ground in the market, which is why I'm very, very reluctant to say that there's no version of the future where strategy is not going to run into trouble. I have to be responsible and say, am I bullish? Yes. Am I a long-term believer and holder? Yes. Have I really done the homework to say there's absolutely nothing that can go wrong? That's the other question that I need to ask myself, and that's the other question I need to answer. And that's why I bring up all of these considerations. It is unrealistic and it is unwise to just assume that strategy is a foregone conclusion in terms of success. And I think that they don't assume that they're a foregone conclusion just by how conservative and how very, very methodical they've been with how they've been doing things. Therefore, I shouldn't either.
If you live in Europe like I do and want to buy Bitcoin the right way, check out Relai. Relai is a Bitcoin-only platform with no distractions, no shitcoins, just BTC. It's also the easiest way I've found to do what actually works, buying Bitcoin on a consistent basis. Relai is also self-custodial. They never have the keys to your Bitcoin. No freezing of your assets, no counterparty risk, no rug pulling whatsoever. I have been a long-term fan of Relai, not only because it's incredible easy to use and very beginner friendly, but also because it just works. If you want to get started with Relai today, click the link down in the pinned comment or in the description, and once you have downloaded the app, type in Robin in the referral code section of the app to save 10% on fees. So set up your DCA Bitcoin plan today with the Relai app and get cheaper Bitcoin if you use code Robin. With Microseed, you can engrave your 12 or 24 word seed phrase, the entire seed phrase, onto a 1-inch small washer. Yes, just one washer. All 24 words on that one washer. You can hide that thing everywhere. And even better, you don't need to buy a new kit every time you have to get a new wallet. You can make unlimited backups because Microseed is not selling the washer. Microseed is selling the device that stamps the washer. So you get the full kit with the device, with the washers, with the hammer, with everything you need to get started today. And you can make with that unlimited amount of backups. Go now to microseed.io. Finally, we have BTC Prague back in 2026. And this year, I'm not only speaking on a panel, but I'm actually going to present an interesting new angle, a perspective, a Bitcoin thesis at BTC Prague this year for the first time ever. I've never done that on any other conference, so this will be a fun one. If you listen to this show on a regular basis, I would love to meet you in Prague this year. It's very high signal, no noise, and Prague is just a freaking amazing city with awesome drinks and a lot of good food. Use code Robin to get 10% off, and if you buy with Bitcoin, you get an additional 5% off your ticket price. I'll see you there in Prague. Make sure to come say hi.
Now, I think let's talk about Stretch a little bit more like on the bullish side, because I've heard that term a lot. And when I looked into Stretch, I kind of agreed, because for me, it's a big deal having Stretch into MSTR. The other products were already amazing and were doing good, but the volume and the awareness and the attention that Stretch is getting is on a whole different scale than all the other preferreds and all the other things that they have been doing so far. Is it fair to say that Stretch is the iPhone moment of strategy for Bitcoin treasury companies?
Is it possible? So the iPhone moment is, it's something I've repeated myself, but I don't like using it, just because I think it has other implications that are perhaps a little bit premature or heavy-handed. But with regards to Stretch itself, yes, I think it is. I think they have a winner. I think that they have the offering that I don't want to say that they were waiting for. I think they have the offering that they were gunning for. The reason why they had the different offerings between, first with Strike, that was Stripe, that was Stride, and now it's Stretch. They have the different offerings. They're trying to target different capital allocators in the market, and they're trying to find their niche, right? I think the success of Stretch has shown a few things, and this is just my read on it. One, that there was obviously demand in the market before a monthly dividend paying offering where people can park their cash with reduced volatility, with reduced risk to the overall capital, and earn a dividend on it, right? So that's clear. The second thing that has showed that there was a demand for is Bitcoin being financialized in different ways. They had the initial offerings for all the other preferreds that brought them billions of dollars, and then Stretch brought them billions of dollars. But like you called out, Where this is different is the demand for Stretch has been steadily ticking up. So they got the first initial boost from it in terms of the initial money that they got for buying Bitcoin. But what we've seen is that Stretch has been stabilizing. Stretch has been recovering after the ex-dividend date. Stretch has been showing itself to be resilient, even though Bitcoin's in a bit of a downturn. All of that tells me that the market was had desire for an offering like this, and they just had to find the right wrapper, and that's what they have right now. And I think that Stretch, as the year goes on and as we see the Bitcoin price action, if it goes, sideways, if it's a year of chop, and they're still able to acquire Bitcoin, I think whether they are able to acquire 100 or 1,000 Bitcoin doesn't matter. What they have shown is that they have another offering that's adjacent to the primary equity, just like the other offerings, that regardless of market conditions, they're still able to acquire Bitcoin. And one of the things that I've been, perhaps the critical is the wrong word, but let's use the word critical, is that strategy has been what I like to call price agnostic, but this makes them market agnostic. And what I mean by that is they've been price agnostic because their assumption is the same assumption that we have. Bitcoin is going to go up over time, so you should be relatively price insensitive. You should just buy Bitcoin when you have the money. Okay, fine. My criticism has been that a company shouldn't just smash buy all the time. You have to think of different things if you are an operating company. Set that aside. Now you have Stretch. They're able to have a offering and have a source of future capital that doesn't put as much direct pressure on the common stock in terms of buying Bitcoin. And what I mean by pressure is, I'm not saying that the ATM was driving price. What I mean is, if the market conditions are not cooperating, they cannot buy Bitcoin, right? However, if Stretch is able to operate and allow them to buy Bitcoin regardless of market conditions, like it's been showing that it has been able to right now, that fundamentally changes the overall trajectory. And regardless of market conditions, they don't always have to rely on the common stock being positive or having the trading volume to justify buys. They now have the preferred equities, specifically Stretch, that allows them to buy Bitcoin regardless of what's happening with the common stock. And I think that's a very, very powerful tool.
I'm so impressed because if you look back in 2022, they had the year where I, I don't remember the exact numbers, but I think 2020 and 2021 they had about 1,000 Bitcoin accumulated per week, and I think 2022 was around like 100, 150, something like that. Because back then they relied on the market. I think that's kind of what you're also saying. Now we have bad sentiment in Bitcoin. We are down 40, 45, 50%, whatever the exact number is in the Bitcoin price. And they are still able to not raise the same amount of Bitcoin as in 2021, like 1,000 Bitcoin a week. They're able, on average, I think in 2006, like 5,000, I don't know the exact number, but massively more Bitcoin, about I think 7,000 Bitcoin per week in 2026. So this is like, oh, they found a way to buy Bitcoin if when the market also is low and kind of down. That is a huge step because this allows them to also benefit from the lower Bitcoin price and not buy his popular saying, "I will buy the top forever," is amazing. Like from like a just like a talking point, but actually from Bitcoin price accumulation, you want to buy the top and especially the bottom forever. Like buying the dip is a very powerful thing because then you kind of really rise up faster than that. So that's been really fascinating to see this bear market, how resilient they are to the market, and still an accumulation machine.
Yeah, and that's why I say price agnostic and versus market agnostic. Another way you can think of it is price insensitive versus market insensitive. Whichever way you want to phrase it, the reality of it is the same. Price before, they were very, very insensitive and agnostic to the price, but of course that's market dependent. Now the market is not cooperating and they're still accumulating Bitcoin, even when Bitcoin is down, even when sentiment is down. Stretch allows them to do that. That is very, very powerful. And I think if they are able to ride this out, this market downturn out, they'll be handsomely rewarded on the other side of this thing.
But you said in the beginning that you think they have to keep on doing something. They cannot just like sit on the thing, the stretch, and they kind of have to keep on doing something. So maybe just for me to think about how you think about it, it's if we just for the sake of the argument say stretch is the iPhone moment, they kind of have to build the app store, the airports, like all the ecosystem around the iPhone. They have to build the distribution channels. They have to go to T-Mobile and all of that to get the iPhone in everyone's hands. So this is kind of how you think about it, where like, okay, they found a winner, but they still have a long ways to go to make it a true iPhone moment, to build everything out in the long run. Is that like a fair assumption?
Yeah, so let's go with that analogy of thinking of the building out towards the iPhone moment kind of framing, right? Right now they have 5 offerings. They have Strike, they have Strife, they have Stride, they have Stretch, and they have Stream. Okay, in the European market. If Stretch is the iPhone moment using your framing, so let's think through what that means. They would have to build the different apps. I did a post, I think a few days back, where I said, would it be possible for them to do a Stretch, up Series A and a Stretch Series B? And what I mean by that is they have Stretch with the current ex-dividend date, and they do another version of Stretch with a different ex-dividend date, perhaps with different terms at a different interest rate, that will allow people to get a bi-weekly paycheck of a dividend directly from strategy, right? I think that's one way they can adopt and expand Stretch. Does that mean another offering on top of everything else, or does that mean reappropriating one of the existing offerings for that purpose? I don't know. I don't know what that would look like, but I don't think that there's anything that prevents them from doing that. So I can see a consolidation of the other offerings into a consolidation or a repackaging of other offerings into different structures to go along with this iPhone moment. If the monthly is the hot spot, are they better served in theory by 2 monthly offerings or 1 monthly offering and 3 quarterly offerings? Are they like where does that calculus go? I think that's another way that they can innovate. And when I say that they have to do things to differentiate and to innovate, I don't mean they need to keep coming out with things on a monthly basis, on a quarterly basis. What I mean is, as stress stabilizes, so let's say over the next 1 to 3 years, I don't think that I think the market's going to adjust to that. I think that the market is going to treat that as a new reality, and then the market's always going to be looking for what's next. That's the nature of markets. They are sentiment driven, they are narrative driven, and they're always going to be looking for what's next. And I think that the biggest challenge that's going on in the Bitcoin Treasury company space right now is that the market's been looking for what's next. Stretch, the preferred offerings, that benefit has not been directly reflected into the price of the common stock in terms of price appreciation. It has been reflected in terms of options market volume and trading volume. That has been present. But I think it's going to take some time for price appreciation to become the beneficiary of that. Now, once that happens, I think then they'll have to innovate again. I think they'll have to go forward again, whether that's through expansion, whether that's through new offerings and whatnot. I'm very, very reluctant to say that they have found the magic bullet and this is all they need to do.
Yeah, I guess it's almost like someone born with talent still has to do a lot of hard work to actually build on that talent and be the great, I don't know, singer, like a soccer player, whatever. Like just having that silver bullet doesn't mean like you have everything you need. You need to keep building and like hammering down on that. Like really interesting how you look at that. One thing I just remembered that I think I saw it a couple of weeks ago on Twitter, that Strive, and this is kind of what confused me, that Strive was buying Stretch. And Strive, just for the people that might not know, has a similar product than Stretch with SADA. I think it has a little bit of a higher yield, but it's like a similar product, similar market. and they are going ahead and like kind of buying the competition product. That really confused me. Like, how do you think about Strive buying a product directly from strategy?
I don't think it's confusing at all. It's actually something I've actually suggested to Bitcoin treasury companies before this point with the other offerings. And the reason why I have is that don't think of it as buying the competition. Think of it as a company having different securities holdings in their treasury. Now, you can say that Stretch is a competitor to SATA, which it is. However, in terms of capital management, in terms of maintaining and growing a capital stack, you want to do things in a way that makes it sufficient, and you want to do things, efficient, and in ways that can make it self-sufficient. That you have different holdings that help you maintain the capital stack that you can leverage and appropriate in different ways. In my view, corporate adoption of the preferred offerings is another wave of adoption that we're going to see. I see a future where companies outside of the Bitcoin treasury companies outside of this space will hold Stretch on their balance sheets as just another holding. And I think that that is a natural progression for the offerings. If you take a look at all the companies that exist in the world right now, they hold all kinds of different securities, equities, and assets in their corporate treasuries. It's just not something that is broadcast, but it's something that exists. The reason why it's getting attention here is because this is a very, very nascent space that's still growing. So Strive buying Stretch as part of their corporate capital stack, it's not that surprise. It's not that surprising to me. I thought it was going to be a natural progression. They are just the first one to do it, or one of the first ones to do it, rather, because there've been other companies that have done it, like Orange and a few others.
That it's I guess it's just hard for me to think about like that. Is is there any way or like any world where you see strategy doing something similar, buying a preferred from another company?
Well, if you think of it, they are, and this is why you have to think of it. I think of it a little bit differently in terms of, is this competition or is this just strategy has built the market and now Stretch and other companies are participants in the market. I think that what strategy has done is they've built the market, right? They have um, created the offerings, and now the market is doing what it does. Participants are coming in, and they're deciding how to be participants in the market. So I don't know if strategy benefits or has any incentive to participate in the market they created. Right? They've created the market. They are the market. Therefore, they're not incentivized to become participants in that market. I don't know if it would make sense to them. Now, could they do it in the future? Theoretically, perhaps, but that's just the way I view it. If I were to create a market, if I were to become the person that creates a new offering, creates a new series of products, and so on and so forth, that then attracts market participants, I am then not incentivized to participate in the market that I created. But that is just my opinion.
It's interesting, and I guess it's also a very early space where we will see a lot of things developing, and the space probably looks very different in 5 years than it looks right now, and it will look very different in 10 years again. It's a very nascent space.
Yeah, absolutely. And we're gonna see growth. We're gonna see different adoption patterns. We're gonna see different, um, you know, offerings. We're gonna see a lot of change. Right now, the preferreds are less than a year old, right? So we can't really make too many assumptions about where things are gonna go, other than typically for these kinds of offerings, it takes 3 years, 2 to 3 years for the market to view them as steady state. I don't know if we can assume that it's going to take the same 2 to 3 years, considering the Bitcoin collateralization and the relation to Bitcoin. But again, that's all um, the different kinds of narratives and different kinds of realities that the market's going to reconcile over these next 2 to 3 years as these offerings, especially Stretch and SATA and others, stabilize, get to steady state, and then have a market presence.
That's crazy. It's so interesting for me, the whole space, but I want to get another topic in today, even though I have like a million other questions around strategy. Maybe it ties also interesting in strategy and Bitcoin also in, because you wrote a piece on sentiment, and I just saw it right before we started the recording. So I was just putting it into the robot and asked the robot, hey, what are like the 10 biggest takeaways from that? And just that was really intriguing for me. And so the piece was something called with sentiment, an expanded thesis on markets and valuations, something like that. What is it about, and like why did you write it?
So the two words that you can take away the from the title is without the adjacent is sentiment as substrate. So what I mean by that is based on my experience in the market, based as someone that has been investing for over 20 years since he was a teenager, as someone that has been observing markets for a very, very long time, my view, and I think it is supported by both reason, experience, and information, is that markets are fundamentally driven by sentiment. Sentiment is the first impulse, the first cause of market action. And what do I mean by that? I often walk people through a thought experiment to help them understand where this is coming from. They often say that markets are forward looking, right? So what that means is you allocate capital today for an outcome tomorrow. That's the very, very simple way you can think of it. But we can't objectively know the future. So there's no objective information from the future that can possibly inform our decisions today. Therefore, how could our decisions in the market to allocate capital be objective? They can't. Fundamentally, by definition, logically, whichever way you want to spin it, a allocation of capital cannot be an objective decision. So the way that we bridge that gap between what we know today and what we hope to happen tomorrow is sentiment. Now, people think of sentiment as emotion, but that's actually not an accurate definition. The way I structure sentiment, just based on the research I've done on this and based on the way that I understand these concepts, is that sentiment is fundamentally a dance between perception, judgment, and conviction. Perception is how we perceive the market. Perception is how we perceive information. That is not done in a vacuum. We do not look at something without our own subjective bias, our own experiences, our own opinions informing how we view it. Because information by itself is inert. Information by itself has no qualities whatsoever until we project those qualities onto it when we perceive it. That is the act of perception. The judgment aspect is now that we've perceived the information, we are making judgments on it. It is impacting our decision-making process. We've received the information, we've taken it in, we've internalized it. Now that's going to drive our decision-making process. So that is a link between perception and that's a link between judgment. Conviction is where the allocation of capital happens. You can perceive this information, you can make judgments on the information, but in the market, it means nothing until you allocate the capital. So sentiment isn't emotion. Sentiment is perception, judgment, and conviction leading towards allocation of capital. And that is why, very, very fundamentally, the market is sentiment driven. If allocations of capital are forward facing, if they are future oriented, they cannot possibly be objective. There's no way for them to be objective under that kind of a structure. So what that leads to is if all allocations of capital cannot be objective and they are in fact sentiment driven, what that means is the entire bedrock of the market is subjectivity. It is sentiment. That is what's driving all action in the market. And I would often get challenges to that people say that they talk about, well, trading algorithms. Okay, does a trading algorithm act independently in the market or does it act autonomously in the market? I would say that it acts autonomously. It is not independent. Independent means it acts like you and I. We decide to make a decision, we make the decision. An algorithm is operating off of rules and constraints. It reacts to the market. It doesn't set the market. What about passive indexes? Same thing. What is a passive index? A passive index is a price taker. A passive index goes into the market and gets allocations based upon the prices that are set at market. There are all kinds of different ways that we can think it through, and that's just me kind of giving like a 2-minute distillation of it. But the essay itself, the thesis itself, is over 30 pages, and I go through a very, very detailed breakdown of the efficient market hypothesis. I go through reflexivity. I go through passive allocations. I go through trading algorithms. I go through the flaws in each concept. I go through how sentiment impacts all of them, how sentiment relates to volatility, how sentiment relates to risk allocations. I go through a very, very systematic breakdown of all of these concepts and how sentiment plays into them. But the overall thesis is very, very simple. If sentiment is a fundamental impulse for the market, which I challenge anyone to come up with a way to undo that logical conclusion, that means that everything in the market is downstream of sentiment.
The most important thing for your Bitcoin journey is not buying Bitcoin, but it's how to keep them. And yes, you have maybe the right tools, but how do you actually go ahead and stick it all together so it's the most secure for you personally? Self-custody is a deeply personalized journey, and the Bitcoin way is helping you exactly finding that correct setup for you personally. They are also helping you with securing your own cybersecurity. And if you want to go one step above all that, you can even get a consultation for a Plan B residency. Go to thebitcoinway.com/Robin and you will get a 30-minute free consultation. I finally and officially mine Bitcoin. This is not just something to stack more Satoshis, but it's most importantly also to support the network. Individual miners are the ones that keep the Bitcoin network decentralized. And by the way, you get KYC free Bitcoin. That's why I use Simple Mining. I get an actual proper Bitcoin miner. They set it up for me. They repair it if it breaks down. And most importantly, they let me choose the pool and even connect my own full node. I'm completely sovereign and I'm completely in control, and I can sign up with Ocean, no account needed. I just give them a Bitcoin address and then there's mining going on. No KYC, nothing. So if you're ready to mine Bitcoin, go to simplemining.io, tell them you come from Robin, and let's mine Bitcoin together.
Is sentiment kind of downstream from narrative? So like the
No.
sentiment in this market is?
No. So how does a narrative form without sentiment? And that's the thought. That's the other thought experiment that I actually have in the essay. It really goes sentiment, narrative, price formation, because people talk about narrative and people often say that, well, price, narrative follows price, right? The price is set, the narrative follows. That's actually incorrect, because if we think about it and just think about it very, very logically, is price something that exists in the market in and of itself? Does price just happen? Does capital allocation just happen? If the logical conclusion of sentiment being the first impulse, what that means is price can't follow narrative. Narrative doesn't come after price. Price comes after narrative. Price is something that is a function of sentiment, and narrative is also a function of sentiment. A narrative can exist with or without price, but price cannot exist with or without narrative. Price is not something that exists in the market by itself. Price is something that's set by the market. And if the market is fundamentally sentiment driven, that means that price is a function of sentiment. And what that means is sentiment builds narrative. And what that means is price is a function of narratives in the market.
So just for me to understand it correctly, let's say that is for every kind of market. So it's like Bitcoin strategy, like all stocks, like this is kind of like a thesis for all assets that kind of have a price. Are also commodities and like, I don't know, milk and stuff.
Well, milk is, I don't know if we want to use milk as as an example, But if we use commodities, it's very, very similar. If a commodity was priced at the cost of production, at the cost of extracting it, so let's use gold. Gold isn't priced at the cost of getting it out of the ground. Gold trades at a premium. And I can trade at a discount. And another thought experiment that I have in the essay is, if something is trading at a premium or a discount, that can't be anything but narrative driven. Why would the market rate something less than it's worth, and why would the market rate something as more than it's worth? And people often come up with a lot of, ways to justify it. But again, sentiment is a first impulse for market activity. What people don't buy gold because they think that it's worthless. They're obviously expressing a preference for a price point when they buy gold, and that is what drives the price. So my formulation, people often go through a epistemological view, focusing on what they can know and what they do know and what they can observe in the market. My view is ontological. I take a view that focuses on what is necessary for the market action, what is necessary for first cause, what is necessary for the action to take place in the first place. That is sentiment, because if we were to remove humans from the market altogether, market activity ceases, right? So therefore, the impulse is always human sentiment, human allocations of capital today for outcomes tomorrow. And again, I'm really distilling it down, because if I gave you every aspect of the thesis, we'll be talking for the next 3 hours. But just think of it very, very simply. Just if I had to give someone one point to focus on, it would be uncertainty. If we are making decisions today for a future outcome, that decision cannot be objective. That allocation of capital, since we cannot know the future, cannot be objective. What that means is price is a market outcome, right? But it is not an objective market outcome. It is an objective result in the sense of a price is set, but it is not objective in the sense of it is a concrete result that is absent of sentiment, that is absent of subjectivity, that is absent of anything else. The impulse for the market is always sentiment driven.
What does, or like, how does this impact average investors that now try to make decisions where to put capital, where to put the next dollars that comes in with the income that they have?
I would say informational density. You want to have an allocation of capital towards something that has a durable narrative. If you think of it in terms of you're trying to identify intrinsic value, which I also go into in great detail, you're kind of chasing your tail. If the logical progression, if the actual informational progression, if the consequences of everything I'm saying is true, allocations of capital are not towards a definition of value. It is towards a definition of a durable narrative and what will attract capital. So if we were to use NVIDIA and the AI trade, right? They've been calling for a bubble now for years, but the bubble still continues. What that means is it is a durable narrative. Now, does that make it an indefinite narrative? No. And that's why I talk about informational density. The more well-informed your decision is, the more well-informed your allocation of capital is, the more durable the narrative is around that allocation. And that is what should drive the decision. We are looking towards identifying durable narratives in the market, not through a essentially self-defeating search for value. Because if NVIDIA, using that example again, is seen as valuable today, but something happens in the market and it crashes by 50%, is it all of a sudden not valuable by 50%? Or just has the narrative shifted? Or perhaps is the narrative not as durable as we thought it was? Do you see the distinction? You cannot possibly know the future, but what you're trying to do is you're trying to allocate capital towards that uncertainty. And the only way you can do that is through finding out what has durable narratives. And some of the most durable narratives we've seen in history, if you want to go back to commodities example, you have gold, you have silver, so on and so forth. We are now we are existing in a market where the narrative durability is constantly being tested. And the companies and the equities that survive are the ones that have the most durable narrative.
Is there an impact that now AI has on capital allocation because it brings this information density faster to individuals? Like you can dive deeper into topics faster and more accurate than like 50 years ago?
Yes, it does bring informational density into play much more quickly in a way, but is that a function of AI or is that a function of the access to the information? And this is also why I go into the efficient market hypothesis, right? Informational density is good, but the availability of the information does not necessarily mean a uniformity of interpretation. So even though informational density is necessary, you also need to be able to interpret that correctly. So I think that even if AI brings in informational density far more quickly, the interpretation of the individual, the interpretation of the market still plays into the impact of that informational density. So AI will have a factor, but it still comes down to market actors and how that information is absorbed and how that information is acted upon.
And the thing that you bring up is the what is it called, the effective market hypothesis, like the thesis. Is that that's just a saying that the market is efficient because everyone has the same information, which like I fundamentally disagree with.
Yeah, so that's one of the key tenets of the efficient market hypothesis. People have access to information. Information is moves through the markets efficiently, and they have and we again this will be another long conversation. There's a strong form EMH, there's a weak form EMH, and there's the semi-strong form of EMH. Right? Those are different versions of the efficient market hypothesis, and it all breaks down to information and how it's absorbed in the market. But there are a lot of the reason why I brought up the interpretation of information is because there are a lot of flaws with the EMH that I also go into in the essay. So availability of information does not mean that information will be absorbed the same in the market. So that's one flaw. The second flaw is information proximity. You or I would not get information as quickly as someone that is sitting in a boardroom. You or I will not get information as quickly as we just saw with the oil prices in the market. Someone got information before everyone else, right? And we saw how quickly they were able to benefit from that. They were able to make $100 million in under 20 minutes. That information flowed through the market, but they clearly had earlier access to information before everyone else. So it is not just, you cannot just say that information flows through the markets efficiently. There are all kinds of constraints and there are all kinds of realities that come into the flow of information. So again, the availability of information does not mean that there's a uniformity of interpretation. The availability of information does not mean that everyone is as close to the information as everyone else is. There's going to be as information flows through the market. If you think of it as a flow of information, there are going to be people at different points in that transmission of information that get the information before the market does. So there are all kinds of things that play into how information exists in the market. So it's not markets are not efficient. If anything, markets are not about information flowing through efficiently or symmetrically. The market is about information asymmetry. So markets exist because the information flows through asymmetrically, not because they flow through the markets symmetrically. There's too many things that go into that.
So then the whole game of investing is catching a sustainable sentiment, a sustainable narrative that you find with information that you think most people haven't found, like, I don't know, Bitcoin in 2012, where you found this interesting thing and you think this could be a sustainable sentiment narrative product in the market that a lot of people will want, and catching it before 99% of the people discover that. I mean, it's like it's easier if you sit in the boardroom of a company making a decision. Like then it's like obviously that you have an advantage. I mean, then we can get in the whole insider trading kind of a thing. But even if it's public available information, doesn't mean that the whole public actually has that information. I mean, if you go out on the street and ask people what's the block size of Bitcoin, I would be surprised if you ask 200 people if you get 3 good answers. So there's not like there is a information asymmetry always in the market, and it's kind of like figuring out if the small information that you have has a sustainability to grow and reach more people. Is that a fair assumption?
Well, that's why I say durable narrative. So you have a few pieces that go into that. And one of the things I say in the essay is that the market doesn't reward people who tries to define the trend. The market rewards people who identify the trend. And what we have going on right now is the vast majority of the market tries to define the trend. They see a trend, then they try to say what it is, and they try to justify and rationalize what it is, whether that be through valuation, whether that be through an efficient markets view, what have you. What they're trying to do is they're trying to perform a post hoc rationalization on what the trend is. What really makes you money in the market is identifying the trend before it happens. You're trying to see the trend before it happens. You're not trying to define the trend. You're trying to say to yourself, oh, I see that this is happening. This seems like it's a worthy allocation of capital. This seems like it can be a durable narrative. My decision is well informed. You identify it, you allocate towards it. That is the fundamental paradigm shift that I'm trying to get people to be aware of. You're not trying to define the trend, and you're not trying to say whether the trend is right. You're not trying to say whether the trend is justified. You're trying to identify and find durable narratives. You're trying to identify and find durable trends. And the reality of it is that anyone that tells you they know the market, I think, is making a fundamental miscalculation. They have a theory on the market and they're willing to make a bet on it, is the best way to describe it. But I think it was Bill Miller, and I have the quote in my essay. 100% of the value of the company is in the future, right? So that is what you're allocating towards. You're always constantly allocating towards the future. You can't do that objectively. You can make an informed decision, but you cannot make an absolute decision. And that is why I talk about information. That is why I talk about the nature of uncertainty. That is why I talk about the nature of capital allocation. If we have a realistic appraisal of what it is we're doing, we can better understand why we do it. But if you operate under the assumption that you can somehow define the market and put it into a box and then make decisions upon that, you're always going to be behind the trend, because by definition, everything in the market is a lagging indicator. We only observe it once it happens. So we're always behind the trend. And if we are operating on a view that you can put the market into a box, you are fundamentally, logically, factually operating behind the trend of the market. You're observing everything after it happens. What I'm trying to say is, if we accept that everything is subjective and we have that kind of a view and that kind of a lens on the market, and we are trying to then identify trends and identify durable narratives, identify things that can be durable allocations of capital versus trying to define what is valuable and what is not, it gives you a different view into the market. And also, it changes the way that you can analyze the market as well. I also have another section on that where fundamentally, all analysis in the market operates off of data points that are assumed to be financial data. That requires one school of thought, that requires one kind of analysis. If my thesis is correct and it's actually that price data, that market data is derivative sentiment data, you can model it a whole entirely different way with a whole entirely different set of assumptions that gives you an entirely different view into the data. And that is what has been driving my thesis. I'm trying to find different ways to analyze the market.
This is so interesting, because I also ask myself often, because I've been a Tesla investor before it went crazy up. I think I made like a 10 or 12x with that. And all the time, like I was the only one in my environment that liked the stock. Literally the only one. It was like years ago. Like I think I started investing in Tesla like about like 9 years ago, and I stopped investing in Tesla probably like 5 years ago, 6 years ago, something like that. And in that short time frame, it just like went up like crazy. Um, and almost everyone in my immediate environment called me crazy, and I doubted myself a lot. But I was like that's a really like I just see the fundamentals getting strong and strong. And this was just the point where Tesla flipped from being not profitable to being profitable at that time. And I like the whole narrative. I like the thing that they're building a lot. And it's also fun to see now, like 10 years later, that the things that I was actually thinking about kind of playing out with them now. Um, but I was always wondering, like, how does other people not see that? And with Bitcoin, it was even stronger. Bitcoin was even more extreme, where I'm like, okay, I thought that Bitcoin is a scam before I invested in it, and then I researched it, and then I like flipped on Bitcoin in 2020, and I was like, oh, that's actually really interesting. And I tried to explain it to many other people, and I think I've been successful with maybe 5 of my friends and like 3, 4 family members, and I have a huge family. So like not a lot of people have been successful in orange pilling. Actually, I'm not a good orange piller. That's for sure. Just from a success rate. And I always ask myself, like, why don't we see the same like they focus on such small weird things, like a small narrative, so much noise, like, oh, Bitcoin is bad for the environment. I'm like, yeah, but like like how how does it, like, did you not study like the fundamental, why do you stop there? And there's like something, I don't know if you covered that, but like there's something with people focus so much on the noise of an asset and like don't try to dive deep and see like what is the actual information, the how do you call it, the durable information within that, the signal kind of in the asset, what actually is deciding if this is a good or bad investment. I don't know if this makes sense for what I'm saying, but like
So,
it's kind of weird from.
yeah, so the informational density, that's what you're referring to. So people made if we use Tesla or Bitcoin as the example, people have made their decision based on what they think the correct information is. But the reason why I'm very, very specific in the essay talking about the impact of subjectivity and sentiment is because, and even in how I dismantle the efficient market hypothesis, that information, you don't perceive that in a bubble. Your biases are impacting how you perceive it. It is just that your particular biases, my particular biases, didn't impact us viewing Bitcoin, Tesla strategy negatively. They allowed us to understand it with over time. Again, narrative durability in a positive way, and identify the potential trends and decide to allocate capital towards that trend. Because the whole notion of a fundamental, if you think about it, and again, I go into this in very, very, very great detail. What are fundamentals, like a price to earnings ratio, or in the case of a Bitcoin treasury company, it's their multiple net asset value or their Bitcoin holdings, or so on and so on and so forth. Okay, fine. You if you're if everything trades at a multiple, which Tesla does, which Bitcoin tends to do, from to its to the cost of mining gold, what have you, everything is trading at a multiple. The only justifiable multiple should be 1. Every Bitcoin should be priced at the cost that it costs to mine. Every gold, every bit of gold should be priced at the cost of mining. Every equity should be at the cost of price to earnings of 1. There should be no multiples to anything. So every fundamental we see in the market, if it's trading at a multiple, take it back to my thesis. You cannot objectively know the future, but you're still trading things at a multiple. Every single multiple is a derivative of sentiment. So fundamentals are just a rationalization of our own individual sentiment. It just so happens that our sentiment happens to agree with Tesla. It happens to agree with strategy. It happens to agree with Bitcoin. Everyone else's doesn't. And the test is the market is going to determine which narrative is right. And that's why I say durable narrative. If your narrative is durable, it's going to survive the attempts that the market makes to displace that narrative. Bitcoin has gone through several instances where people have said it's dead, right? Then it comes back. Then it's dead again, then it comes back. It's a bubble, then it comes back. You see what I mean? That is a durable narrative. And Tesla has had a relatively durable narrative. Strategy, despite what people say, and despite the downturn in price, it still has a durable narrative. And that is why I differentiate between fundamentals and what's actually logically, practically driving the market. A fundamental to one person is not a fundamental to another. There's no universality in a fundamental. Therefore, it cannot be objective. It is opinion driven.
Yeah, that makes a lot of sense. It's such an interesting topic. It's really fascinating to think about how valuation comes. But it's also so human driven. Like we think there's like models and like sentiment driven. So yeah, but like the sentiments, I guess the sentiments come from humans, right?
Yes, but the reason why I don't say that sentiment is not just a proxy for human action, that I have again, I have another section on that as well. It is not just humans driving the market. No theory is going to dispute that, right? The reason why I say it's sentiment is that humans being in the market does not necessitate an allocation of capital. What is going to cause them to allocate capital? Humans existing and driving the market, that's not specific enough. That's just a very, very general, very, very ephemeral statement. What is driving the market is the impetus for human action. It is not the human, it is what is causing the human to act in the market. And that is sentiment, that is perception, that is judgment, that's conviction.
Interesting. Yeah, there's a lot to, I think, with strategy, with stretch, with all the other companies, and now with that thesis, you've given me and my audience definitely a lot to think about already. So I will close today's episode here, and I think we've covered a lot of ground today already. As you might know from the previous appearances that you've done on my channel, we have an end routine on our podcast where the previous guest is asking a question for the next guest without knowing who the next guest actually is. And the previous guest asked you a very fitting question. I think it's almost as you have known who you are. He asked you the question: if you had $50,000 right now to put to work today, how would you invest it? BTC, MSTR, or Stretch?
I'll give the easy answer. I'll put a third in each. Just keep it simple.
That's fair.
I wish I can give a more sexy answer, but that's probably logically what I would do. If I just had $50,000 that I didn't anticipate, right? That I wasn't already allocating for, that I wasn't already accounting for, and I had to make an allocation, I would do a third into Bitcoin, I'll do a third into strategy, I'll do a third into stretch.
And if you had to choose one,
I don't operate that way. I wouldn't, because here's the thing, it would have to be dependent upon my current holdings. I'll have to look at it in totality, right? Now, if you want to force me, if I were to make an absolute choice, what is the most likely choice? It'll likely be Bitcoin, obviously. But I'm trying to give the nuanced answer because I operate with nuance. I tried to avoid absolutes. So the nuanced answer that would be my likely answer is that I'll do a third into Bitcoin, MSTR, stretch. If I was giving that, that bullish answer, of course it'll be Bitcoin.
has the highest likelihood of not going to zero, I guess. Really cool. Thank you so much. Yeah, really cool. Thank you so much, Adrian. Was really fun to talk with you about Bitcoin strategy, valuations, humans, incentives, sentiment, narratives. Was really fascinating episode. Before letting you go, where can people find your article or your articles? you as a person, and where can people ask you questions and reach out to you?
The best way to do it will be on X. So my username is _@_Adrian. That's my username on X. The article is going to be on the True North website. That's actually in my profile, tnorth.com. We recently did a redesign. We recently did a bit of a rebranding in terms of our logo and the way that we're presenting information to the market. So my information's there. My article is there under research. The articles from other individuals are under the other topics section. I tend to do more long form stuff, which is why my initial article is under research. And that's the best way to find all the stuff that I'm going to be doing. We're going to be funneling it to the website. We're trying to get off of X. We're trying to broaden our reach. We're trying to broaden the horizon to the broader market. And that's going to be very, very successful for us. So that's the best way to find me.
Awesome. Then thank you so much, Adrian, for being on the podcast and entertaining us with your insights for like an hour or a little bit more than that. And also thank you so much for everyone that is watching and listening, for joining us today. As always, I'll be back. This content is for educational and entertainment purposes only and does not constitute financial advice.